So, Julie, I just had the best fishing trip of my life last Thursday. We caught a ton of tuna off the shores of North Carolina. It was phenomenal.
You're making me hungry, John. I can't wait to hear more about that trip.
Well, it's interesting because we had a conversation with a portfolio manager at Wellington Management named Matt Baker, and Matt himself is a pretty big fisherman. And Julie, it reminded me of that when I was out there thinking about the conversation that we recently had with Matt about how fishing relates to dividend-paying stocks. Who would guess?
I certainly didn't. It surprised me. But we are joined today by Matthew Baker, who's the Senior Managing Director, Partner, and Equity Portfolio Manager in Global Equity Portfolio Management on the Quality Equity team. He is the lead portfolio manager of the Hartford Dividend and Growth Fund. He manages equity assets on behalf of our clients, drawing on research from Wellington Management's global industry analysts, equity portfolio managers, and team analysts. He currently manages the quality value approach and provides research on the consumer, industrial, and materials sectors for his team. He works in the Wellington Management's Boston office. Prior to joining Wellington in 2004, Matt worked as an equity analyst in the Central Research Group at MFS Investment Management, leading the global capital goods team. And before that, he worked as an investment specialist at Bank Boston. Matt earned his MBA from the University of Pennsylvania, Wharton, and his BS in finance from Northeastern University.
And I can't wait for our podcast listeners to listen in on this conversation. So let's go. Hi, I'm John.
And I'm Julie.
We're the hosts of the Hartford Fund's Human Centric Investing Podcast.
Every other week, we're talking with inspiring thought leaders to hear their best ideas for how you can transform your relationships with your clients.
Let's go.
Matt, thank you so much for joining us here today on our Human Centric Investing Podcast.
Well, thank you very much for having me.
So, Matt, I have to ask you, we're at an interesting time in the investment markets. And given that your expertise kind of in those dividend paying stocks, it seems like investors have been chasing the returns on growth stocks for years and years and years now. It's hard to remember that last value cycle almost that we had. And probably a lot of financial professionals weren't even in the business the last time we saw, a kind of a favoring of value oriented or dividend paying stocks. What do you think is behind the shift that we've seen recently? And I know no one has a crystal ball, but do you think that maybe there's a newfound appreciation for dividends in the markets?
It's interesting, right? So you mentioned a pretty interesting time right now. I think that corresponds with my career, right? So I started in 2000 in the industry, right in the middle of the dot-com bubble, and then had a little bit of a reprieve, and then the great financial crisis, and now the inflationary environment we're in now. So these unique periods don't really seem to be too unique when you look at it over a long period of time. There tends to be shocks every once in a while, but you're absolutely right. Over the past, call it 12 to 15 years since the great financial crisis, growth stocks have had an outsized return versus value stocks. If you look historically, the relationship, over the past 15 years, 12 to 15 years has gotten very much out of whack. So if you start at the point of 1-to-1, right? So growth and value are equal. Over the past 5 or so years, that relationship has favored growth by about 40%. I do want to say something real quick, though, before we kind of jump a little further down this discussion, which is that, in this environment, a lot of the debate has been between growth and value. We need to change that debate going forward, right? Because it's not necessarily a choice between growth and value. There's problems on both sides. In an inflationary environment, it's not just the growthy companies that have high valuations that are problematic. It's also the value companies that I would describe more as deeper value companies that are also problematic. Those companies probably don't have the ability to maintain their margins in an inflationary environment, and those are going to be, kind of tough stocks to be in. So really what the sweet spot is, if you will, is kind of the core right in the middle. It's those companies that have a long history of generating cash flow consistently and raising that cash flow and then paying dividends and raising dividends consistently over time. Those are the companies that tend to outperform in more problematic environments.
It's interesting, Matt. You talk about that there are challenges on both sides of the coin, whether we're looking at growth or value stocks. And I think it always occurs to me that times like this are an opportunity for a financial professional maybe to step back and re-educate him or herself on some of the factors, and then in turn, have engaging and interesting and educational and coaching conversations with their clients. If you were sitting in a financial professional seat right now with clients that are uneasy or concerned or just really wanting to understand more, what would some of those talking points be from a financial professional's perspective?
Well, I think it's time frame, right? And so what I mean by that is if you think about the last, so I started in this industry in the year 2000. So I've been in the industry for 22 years and I have gray hair, and I guess I'm kind of more senior in the industry these days, but I've only been in this industry for 22 years. And, as far as I know, there was one point, I think it was maybe a 2-week period in 2005 where inflation was maybe a marginal concern. So what that means is unless you have more gray hair than me, you probably haven't seen inflation. You probably haven't seen an environment where stagflation was being talked about, or, a rising interest rate environment. And so what's interesting about that is the playbook that most investors would use or talk about, or the way they think about investing in stocks, is fairly new. And if you think about that playbook over the past 15 years, you'd probably want to fill a portfolio up with some very, big, fast growing tech companies. And that's great. You're trying to maximize the potential for alpha. But I think what was forgotten over that period, because we didn't really have a bear market with the exception of 2008. And as bad as that was, it was fairly short lived. You forget that dividends historically have pretty much accounted for about 50% of the overall total return of a market. And in some environments, specifically in the 70s and into the 80s, where you have inflation and stagflation, that actually goes way up, right? So in the 70s into the 80s, the percent of the total return coming from dividends was more like 75%. So, dividends have always been an important part of an overall portfolio. I think it's just been forgotten about over the past, 15 years or so when that percent of the overall return of the market has gone way down. However, if you think about the environment over the past 15 years, there was nothing normal about it in the context of history. We had interest rates at zero pretty much. We had quantitative easing the whole time, and you were rewarded for taking risk. The problem with that, though, is if you think about the more growthy stocks over time, they tend to return maybe a little bit more than quote unquote, more stable stocks. However, that's only in good times, right? If you look at the standard deviation around those returns, so in other words, how much volatility there is around those returns, it's the more stable stocks are, over time return a much more favorable total return, because when you go down less in a tough market, what you're actually doing is you're compounding that value more over the course of a cycle. So when we think about investing, we're not thinking about investing for this year. We're not thinking about investing for, the next 6 months. We're thinking about investing over the course of a long cycle. And you have to have the ability to protect on the downside during those volatile times. And really the way to do that is with companies that have recently started to pay a dividend or have a consistent history of paying and raising dividends and have less volatility than maybe the average growth stock out there.
So, Matt, the idea of dividend paying stocks in an inflationary environment, as you as an investor look at these companies, is it that with inflationary pressures on the companies themselves that they'll take in more revenue, hopefully they'll stick to their pattern of increasing dividends? Is that your expectation versus perhaps a company that doesn't pay dividends? No telling how and where they're going to be able to reinvest. So is the strategy with dividends that you're looking for consistency in either maintaining or maybe even increasing the rate of their dividend?
Yeah. So with everything, like we were talking a little bit about growth versus value, and I said that's not really the debate. It's kind of there's problems on both sides. So with everything, it's nuanced, And the way I would answer your question is, again, in a nuanced way. It's not a choice of dividend or no dividend, because not all dividends are created equal, and not all companies that pay dividends are created equal. The reason, we already talked a little bit about how dividends add to the total return. It's an actual return you can spend. But what we didn't talk about is what the dividends signify. And this goes back to that free cash flow generation, which is so important. Companies that have a history of generating free cash flow, growing that free cash flow over time, are the ones that tend to have stable and growing dividends, because you can't pay that dividend unless your cash flow supports it. There are companies that have very high dividend yields, for example, but don't necessarily have the cash flow to support that dividend. And while these are high yield companies, the likelihood of a dividend cut is significantly higher in those companies. And those tend to be more deeper value companies, not necessarily companies that can sustain the dividend over a long period of time. So, what we actually value and what we think is the right thing to think about when you're thinking about dividends and protecting on the downside is the companies that have payout ratios that are appropriate for their businesses, right? So if you take a generic cyclical company that has a 90% payout ratio at peak, well, at trough, that's probably going to be a 200+% payout ratio, and that's unsustainable. So if we're investing in a cyclical company, or if one is investing in a cyclical company, you probably want a payout ratio that is much more conducive to what this company would look like over the course of a cycle. Maybe at peak, it's a 10% payout ratio. On a normal, in a normal environment, maybe it's 30%. And at a trough, maybe it goes up to 50% or so, but they can still maintain that dividend. If you think about a more stable industry, say consumer staples, for example, these companies might have a 50-60% payout ratio. However, if you look historically, the free cash flow would tell you that that's okay, because these companies generally generate a lot of free cash flow year in, year out, and it doesn't really change too much. So the stability of that dividend at a higher payout ratio is fine. So you have to think about the payout ratio, if it makes sense for the industry the company is in, as how sustainable that dividend actually is. And it all comes down to, again, that free cash flow generation. If you think about an inflationary environment, if you do not have that consistent free cash flow historically, you probably don't have pricing power, right? And that's why your cash flow is kind of ebbing and flowing, and it's not maybe the stablest business. If you don't have pricing power in this environment, there is really no way you can maintain your margins. If you think about where we came into this, kind of higher inflationary environment, most companies had pretty much all-time high corporate margins. And now we're seeing input costs spike up just about everywhere. It's funny that, every company that we might meet with as an investor where I work, they're all going to tell us that they can price in this environment. But, it goes back to my comment about gray hair and being in this industry for 22 years. The majority of managers in their own individual companies have never had to price. So, it's not that reasonable to expect every company that comes in here has the know-how and the management capability to price to drive pricing in this environment. There are companies that have a long-term history of pricing power in any environment. These are the ones that we want to identify. These are the ones that we want to focus on, not companies that have had no pricing for 20 years and then all of a sudden they're going to be the price drivers in the industry. It's just not credible.
Matt, it's interesting as you talk about all of these moving parts and the data shifts so rapidly from day to day, from hour to hour, minute to minute. And I know that many financial professionals obviously are experiencing that as well, especially in light of communicating these changes to clients. And that really brings up the power of a team. and thinking about how do we work together? How do we take in information, process it, and then share it? I'd be curious for those financial professionals listening with us. Obviously, your team is taking in so much data, processing it real time, and then trying to push out messaging and communication. Can you give a little bit of insight about what your process looks like, how you rely on your team? Because obviously that's a very rapidly moving train that you all are aboard right now.
So we have a team that specifically focuses on the portfolios I work on. However, that's not really our team. Our team is Wellington at large, and we have an enormous amount of resources here, not only on the value investing side, but on the macro side, on the fixed income side, and we tend to have a pretty good in-depth research effort on really what's going on in the world, and sometimes quite honestly, it's too much, right? I mean, in this digital world we're in, we have such access to information, and you can get lost in the trees, right? And not see the forest. And so, I think the way I think about my job is trying to take all this information and distill it down to what's important, and not only what's important, but what are the likely ranges of outcomes. And so, as we were entering into this environment, there was the first part of the debate, right, outside of growth versus value. The next stage was transient or sticky. And there's as much research that would tell you last year that it was transient as it was sticky. However, when you think about the potential ranges of outcomes and what's being discounted, the market was pretty much at all-time highs, and we had this potential for this inflationary environment, whether it was transient or sticky. You'd kind of have to make an assessment of that. But if the market's at an all-time high, and you're thinking about this inflation being transitory, well, if you're right, I'm not sure there's much upside to that. But if you're wrong, there's a potential huge amount of downside. So you have to marry, not only what's being discounted today or what's showing up today, but what are those potential ranges of outcomes, and are we adequately reflecting those in the portfolio, or how we're structuring somebody's portfolio? When it came to the conversation, a couple of things that we noted here, the inflationary pressure on the wage side was something that I would argue was not transitory. It never really is. Once wage inflation occurs, it's hard to put that genie back in the bottle, and that's actually a good thing. But that would mean that inflation is probably erring more towards the side of sticky than transitory. The other thing I would say is, if you think about the transition, if you will, of driving to your local retailer and fighting with all the other parents for those. In my day, I guess it was a Cabbage Patch Kid. Fighting for those Christmas special items. About maybe 15 years ago, 10, 15 years ago, there was a big shift online, and it happened fairly quickly. We have some of the, world's most sophisticated logistics companies not actually being able to forecast that demand well, and maybe being a little bit short of capacity. And in some cases, it took them a few years to actually figure that out. I grew up celebrating a different holiday around that time. And so I may be off in the dating, but I'm pretty sure Christmas has been around for thousands of years, right? Or at least hundreds of years. And it took these very sophisticated companies 3 years to get it right. We shut down different parts of the world at different times, all these different industries at different times, turned some of them back on, turned some of them back off. There was no way this supply chain issue was going to be transitory, unless your definition of transitory is something that's like years. But if you kind of expected things to snap back in 6 months, I think that was a little bit misleading. So, the net of all this is you get all this information coming in. Sometimes the best thing to do is just take a step back from it and just use common sense. Nobody's ever seen what happened in the COVID environment ever before in their lives, whether you're a 70-year plus investor or a 2-year plus investor. So to think that anybody really knew the outcome, I think was a little bit, maybe arrogant of the investment world. And so, using common sense, it was really likely that, for the Fed or for anybody to get this right would be such an amazing feat that it wasn't necessarily something I think that we would have based a portfolio on. The other thing too is, I'll go back to this notion of protecting on the downside because we haven't had downside in so long. Um, you know, I think investors or people helping people invest forgot what it means to protect on the downside and how powerful that is when it comes to compounding, right? A really simple example is you take $100 stock, the stock's down 50%. Well, you have to be up 100% from that point just to get back to even. You have a stock that's down, 20%. Well, the makeup there to get back to even is significantly less. And the compounding over a cycle then is superior. And there's all kinds of, academic research that would support that. I remember when I was at Penn, there was a famous professor there that actually did a lot of that work. And that's, something I learned very early on in my career, and the power of compounding and protecting in the downside.
So, Matt, I like what you said about range of outcomes because I think as human beings, we tend to think in black and white. We tend to think value growth, bear, bull. It's easier that way. But I think listening to you as a portfolio manager, you're often probably thinking about shades of gray. So you mentioned inflation was the big question last year, the big debate. The question these days seems to be recession. And so the question I have for you is, as a portfolio manager, how do you think about the potential for a recession in the United States? And what is the implication then on the kind of companies that you're investigating and investing in?
So I think first of all, I think there needs to be a new animal thrown in the mix. I think that bull bear is too black and white. So I don't know, maybe there's a wolf in between or something. But I think that if you think about a recession and is it likely in the U.S. Or globally, I would say it's very likely. I think in this environment where you have rising interest rates, you have an enormous amount of pressure on the oil and gas industry right now, and on the food side that I don't see abating anytime soon. Factors outside of I guess not outside of Russia's control, but since the Ukraine invasion, that has caused an enormous amount of pressure on the ag cycle as well as on the energy cycle. I think that's here to stay for a little while, not necessarily just because of Russia, Ukraine, but also because of the lack of drilling to some extent, in an energy transition that will happen over time. That's putting some pressure on the supply side. So you do have to weaken demand. Some of that will naturally occur. I do spend time when I have free time on the water, and I know, from a boating perspective, at least the fuel dock that I get fuel at is down about 45% year over year. It's having a real impact right now. People are just not using their boats as much. I would imagine that flows through all the way down to cars and everything else. So that is kind of, clamping down on demand somewhat, but it is very likely, a recession needs to occur here. And that's not a bad thing given the environment we're in, because if we don't have a recession, what's the outcome, right? We could have a higher inflationary environment with higher unemployment. And that is stagflation, and that's the 70s. And that's not an environment we really want to see again. So it sounds really awkward to say, but, a short, maybe hopefully not too deep recession is actually a good thing here. What type of companies does that mean we'll look at? Well, quite frankly, it's the same companies we're going to look at in good times. It's the same companies we're going to look at, in really aggressive times. It's those companies that have a long history of generating free cash flow growth, doing smart things with that free cash flow. One of the smart things we like to see is giving some of that back to investors in the form of dividends, and companies that have pricing power. These are the companies that no matter what the environment is, are going to be fine. They're going to make it through this environment. They'll be able to price to it. These companies also tend to have, reasonably levered balance sheets. They're not under levered. They're not over levered. That's an important thing. When you look at some of maybe the more deeper value companies in the market, these tend to A, maybe have dividends that aren't sustainable. B, might not have that free cash flow generation. C, probably have stretched balance sheets. And let's face it, they're deeper value companies because they're probably not great businesses and they probably don't have the ability to price.
Matt, I know you mentioned the broader team at Wellington, and I know that they've done a lot of research around dividend paying stocks. And I'm just wondering if there are a few key bullet points or takeaways that you'd be able to share with us today based upon that breadth and depth of research that the Wellington team has performed over time.
So we talked a little bit about the dividend companies, the dividend paying companies. And we mentioned that, not all dividend paying companies are created equal. So if we break it into different buckets, let's talk about dividend cutters, dividend not payers, dividend payers, and then dividend growers. If you look at those different buckets and you go all the way back to, call it the early 70s, what you'll find is dividend cutters, not surprisingly, were actually some of the worst performers in that environment, and have actually detracted value over that period of time. That's about 50 years of detracting value. Non-payers would be next. Dividend payers have actually been pretty good performers. Dividend cutters were the worst performers. Non-payers were the second. Dividend payers did reasonably well, but dividend growers actually outperformed dividend payers by almost a 2-to-1 margin over the last 50 years, right? So even though you're paying a dividend, that doesn't necessarily mean you're going to generate that same type of return unless you're consistently raising those dividends. And this gets back to that free cash flow growth as well. It's all related. So again, the work that we've done is basically showing us that just paying a dividend and keeping it flat for, say, 10 years is really not adding that much value at all.
So Matt, one of the things we talked about in terms of shades of gray and cycles and all that, just your thoughts on the importance of fundamental analysis in markets like these, because there are times that we go through where people say fundamental investors are not rewarded, it's different this time, so on and so forth. In markets like this, is there a greater emphasis on the fundamental analysis work that you all do at Wellington?
Well, I think in any stress-induced environment, well, I'm going to back up a little bit and say in any environment, fundamental research is incredibly important. You really have to know what you're owning, what you're buying. You really have to think through not only what the potential reward is, but what the risk is. And there's all kinds of examples, on companies you can look at to prove that out. But I would say that in more stress times, it's not that fundamental research is more important, but it's certain parts of what you're looking at fundamentally become more important. So revenue growth in a more problematic environment probably is not something I would focus on as much as maybe balance sheet leverage, or that free cash flow generation, or the ability to sustain or maybe even grow margins in more problematic times. So it's not that fundamental research becomes more important. It's just different parts of what you might have been looking at historically might change in favor, other fundamental things that might have been less important. If you go back over the past 15 years, I would venture to guess that most investors would tell you, and I don't think I would have, but most investors would tell you that revenue growth was probably the most important thing to look at. That's obviously shifted. Now everybody is kind of looking more at balance sheets and free cash flow generation and the sustainability of the margins.
So Matt, you hinted at it a little bit. I'm going to give you an opportunity to show off here, and I want to give proper credit.
Okay.
You mentioned that your son had written an essay about fishing. And when you told me that little story, I think it was your son, it reminded me of the conversation we just had about fundamentals. And so would you just describe to everybody kind of what that essay was about and how it actually relates maybe to what you do in your business.
So this has always been a challenge of mine, right? Is to somehow my passion outside of work is being on the water and fishing, and as we get older and we think about our careers, we're asked to do lessons learned at Wellington for some of the younger investors, and I've always tried to relate it back to fishing, and I haven't been that successful at it, but my son seems to have been. So that was basically, we spend a lot of time in our free time fishing for tuna fish offshore. And one of the first things I taught him was that the majority of the fish are actually caught before you leave the dock. And that sounds weird, right? Because we're going out 70 miles. And so how could you catch a fish that far away? But what I mean by that is you really have to do the research as to where you're going to fish before you actually go out. And, the ocean is very big. When you're offshore, there's really no structure around. We fish the canyons, which is a big drop off. But what's important there is, what are the sea temperatures? What's the sea salinity? And we can look at all that before we even leave the dock. So even though we might be going 70, 100 miles offshore, we're targeting probably an area that's, maybe a quarter mile in total. And we know exactly where we want to go before we leave the dock. That's doing the work. But, that's just part of it, right? Because we're also going 70 to 100 miles offshore. I mean, if God forbid something happens, no one's coming to get us, at least not for a long time. So you also have to make sure that you are thinking about every potential risk out there and making sure that you are, aware of all the risks and taking the precautions before you even leave the dock. And so, to me, that's thinking about the potential range of outcomes. If I think about a stock that has 20% upside and 10% downside, well, mathematically, that's really no different than a company that has 100% upside and 50% downside. It's a 2-to-1 ratio. The range of outcomes on the second, the 100% upside, 50% downside, is probably so wide, I could drive my boat through it. I would much rather invest in that company that is 20% upside, 10% downside. That to me is not only the same risk reward, but a much less volatile structure and fewer potential ranges of outcomes. And that, is kind of what my son wrote his essay on. And, he did a good job of it. I might plagiarize it and actually use it for my lesson learned at some point.
Thought it sounded pretty good, Matt, and it'll keep me reminded of the conversation we just had for sure.
Absolutely. I think that's a great story. And, in the work that John and I do with financial professionals, we're constantly encouraging them to craft their own stories and examples regarding many different topics. And so I think for those listening with us today, we would encourage you to craft your dividend story and see how you might articulate that to clients and continue to educate them during these unprecedented times. And we just can't thank you enough, Matt, for your time today and the education and the insight. And thank you for all the work that you and your team at Wellington are doing.
Well, thank you so much for having me. It's been a pleasure.
Thanks for listening to the Hartford Funds Human-Centric Investing Podcast. If you'd like to tune in for more episodes, don't forget to subscribe wherever you get your podcasts and follow us on LinkedIn, Twitter, or YouTube.
And if you'd like to be a guest and share your best ideas for transforming client relationships, email us at guestbooking@hartfordfunds.com. We'd love to hear from you.
Talk to you soon.